So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani, and today I am joined by the great Rob Beardsley. Rob oversees acquisitions and capital markets for the firm and has acquired over 100 million of multifamily real estate. He has evaluated thousands of opportunities using proprietary underwriting models and published the #1 book on multifamily underwriting, The Definitive Guide to Underwriting Multifamily Acquisitions. Rob, welcome to the show.
Yeah, thanks for having me.
Absolutely. We are connected through Raise Masters. Shout out to Adam and Hunter, creating a great network of people.
Yeah, the best, definitely the best group for multifamily and beyond.
Absolutely. Couldn't agree more. So let's kind of go back to the beginning. What is your story? How did you even get into all of this?
I got into multifamily back when I was still in college. I went to school for computer science, so I thought I was going to go down the tech and consulting route, maybe start or join a startup. But my intellectual curiosity brought me to investing. Always was a fan of investing. I'm a long-term thinker. I like delayed gratification. So all those boxes were checked for me as far as investing in multifamily. And funny enough, my family's background is in single family residential housing. So my parents ran a brokerage firm from home. So I was around them all day as they worked from home, on the phone with clients, buying and selling homes all day, and doing some fix and flips and development. But I didn't like their business because it was very client driven. It was very transaction driven. It was on to the next, very frenetic. And so I liked multifamily because it was more stable, long-term, more scalable, and something that I felt like I could really grow into something big.
Yeah, it makes perfect sense. I mean, that's really the biggest thing that you hear in commercial real estate is that scalability, right? And anyone who started, and most people start with some form of fashion in that single family, it really just comes to that scalability and the economies of scale, and you hit it right here. So is your family now moved over to commercial real estate with you, or are you on your own?
Yeah. So at this point, they have retired from the residential business and are active and passive investors in multifamily. Not, we don't work together directly, but they are investors in some of our properties. So it's it's good to keep it in the family.
Love that. That's awesome. So your main focus is the Texas markets, correct?
Yep.
But you live in Manhattan. So talk about how you got into the Texas markets and why you love them so much.
So through a mentor, I met my business partner, and prior to meeting, we were both looking at Texas just because it's a very popular place to be. The fundamentals are great. There's a lot of opportunity. And because we were looking at some of the same deals, that's how we connected through that mentorship program. And we ended up really working well together, started Lone Star together, and never really never wanted to pivot our focus. We felt that, and it wasn't something that we necessarily from the very start said, we have to stay focused, we have to do this. We dabbled around, we looked at other markets. We did buy some other deals outside of major markets in Texas, but at the end of the day, we feel that it's best for us to be focused because it just requires so much effort to have a reputation, have relationships in the market, get first looks on deals, last looks on deals. And then once you close it, it's valuable to have a concentrated portfolio to be able to better manage it. And last year, back in mid 2021, we launched our own in-house property management company called Radiance Living. So with an in-house management company, when you're running your own deals, you can't just have a deal in Arizona and Tampa and Denver, right? You need to have that clustered portfolio, or else you're going to be sending your people on planes every week. So that's another big reason for us to be focused. So over the last 4 years, we bought about 300 million in assets, and the majority of them are in Houston.
Awesome. Love that. So kind of talk about that progression, starting out, obviously named it Lone Star, which I love, focused in Texas. So that fits perfectly. So kind of talk about that progression from, your first deal up to now, and then, even deciding to start your in-house property management.
Yeah, the first deal that we went for was quite big for us. It was a big jump, but we were kind of too stupid to know any better, right? We were just ready to go, and we were ambitious and naive, and fortunately it worked out. But it was a big project. It was a $16 million deal. We had to raise $4.5 million of equity. It was a big task to do, and we kind of took for granted. We took for granted a lot of things. All right, we kind of thought, oh yeah, let's just do this, and then we'll figure out how to raise the money. We'll figure out how to put this together, right? But there was so much that we didn't know, and I think one thing that we did, which is what most people do, is underestimate just how difficult it is to raise capital. Everyone thinks, oh, I know some wealthy people, I can raise some money. But you quickly learn just how difficult it is. And we learned a lesson on that deal for sure, because it was by far the hardest thing. Not to say we didn't struggle with other things. There's plenty to learn on your first deal. But I think the best part about it was that we kept a good attitude and we closed it, right? The most important thing is to get it done. It's not to become a millionaire on your first deal. It's to close it. And step one on your journey of establishing yourself and learning and working towards the next one. So that was the first one. And it, just as I mentioned there, it definitely helped us get the next one, because all it really takes is one. And now all of a sudden the brokers are talking to you differently. You're perceived in the market differently. Getting the second one's way easier. And that momentum just carried us forward, and we were able to kind of string a couple more deals together. And at this point, we're looking to be buying, 250 million to 500 million per year.
Wow. That's awesome. And that's quite the progression. And I love that sort of ignorance is bliss approach you guys had on the first one, take down such a large deal. But like you said, your perception in the marketplace just flipped, because now they understand, did the people you were talking to and kind of partnering, did they know it was your first deal?
Yeah.
Nice. See, and now you got over the finish line. So now they know you can handle that. They know you can handle big deals, and you're in a huge market, which kind of touches on what you said earlier. It's important to focus and stay focused in such a large market like that, because if you lose focus, you'll get passed up very quickly.
Right. And yeah, you brought up a good point. I mean, it doesn't just help with the brokers, it helps with your investors a ton, right? Investors don't want to invest with someone doing their first deal. It's just natural. I mean, I get it. And that's why it just kind of only gets easier with every deal you do, because so it's a really cool thing, because it goes back to that long-term game type of thinking, right? Okay, might be hard now, but with every step we take, it just gets easier and easier. And I kind of liken it to the S curve or the J curve, where at the beginning you're putting in all this effort and you're not really getting anything back to show for it. All this effort, nothing. All this effort, nothing. Really small improvements. And then you reach that tipping point, which I feel like we're just now getting there. I mean, we're still only getting started, but you reach that tipping point where all of a sudden you put that effort in and you get way more results. And you go, wow, this is easier than it should be, right? Something's weird here. So I think, I don't know. I don't know if it's going to get a lot easier, but I mean, we're always going to have struggles. We're always going to be pushing ourselves, but I think we're kind of right at that level where it's already very exciting, but I think it's going to get better.
I love that. That's awesome. And you really nailed it. And obviously, as you guys continue to stretch your goals and push yourself, the raises get easier. You build that bigger, investor base, but then that means just going out and doing more deals. So kind of talk about that progression in your investor list and growing that and what that's been like.
Yeah, I definitely want to touch on that, but I also want to comment on the fact that we just did our largest deal, and we raised $14 million of equity for the deal. And it was honestly, it probably was the easiest raise that we've done. right? It was the
Wow.
biggest, but it was easy. We were oversubscribed. There's a lot of people, a lot of investors, a lot of people to choose from. And it was not that way as I was kind of describing. And it's not like the first one was hard. The first one was hard. The second one was hard. Third one was hard. I'm trying to think. I think the fourth one was even hard. So it's only now just started to get easier and easier, like you're saying. And the as far as the progression and the investors and the email list, nobody was really. I wasn't raising any money 3 years ago when I was writing articles all the time and been making videos for years and have been doing podcasts and have been going around to meetups and conferences and experimenting with what works, what doesn't work, putting myself out there, wasting tons of time. And eventually, like we talked about, eventually the effort starts to show, right? All of a sudden now, okay, yeah, the articles you've been writing actually make a difference. People are reading those and they make an impact. And same goes for all the marketing. We're very focused on the details and making sure that the investor experience is very solid from the very beginning all the way through investment to the monthly reports, the distributions. We're just hyper conscious, sensitive to the investor experience, because we know so well that returns don't sell themselves. We're not in this game for numbers. We're in this game for people. And if you want to commoditize yourself, then just play the numbers game, right? But we don't want to be a commodity. We want to really make a difference. So plenty of people have invested in good deals where they've gotten good returns, and then they said, I will not invest with that person again. That's such a shame, right? That's you got them, you did them a great thing, you did a great deal with them, and they don't want to partner with you again. So that's always top of mind for us. And I think that mindset just bleeds into everything we do, and hopefully results in us actually providing a good experience.
And what do you think is the difference between continuing to get repeat investors and making a $14 million raise simple, as opposed to those who made money but just don't want to invest again?
Yeah, it's communication, which sounds really simple, and it is simple, but it's not easy to do. It takes a lot of work and consistency, right? It's every single month providing updates. We do monthly distributions, so making sure those are on time, making sure the reports are on time, quarterly reports. And then as investors have questions, whenever they do, we just, I never want to see an investor question sit in, one of our team's inboxes for more than 24 hours. That's no good. So those are the keys to success. And it sounds pretty simple, right? Like I said, and it is, but the problem is, as we want to scale, like you mentioned before, it just gets a lot harder. It's fine if you want to do one deal a year, but what if you want to do 10? All of a sudden, that's way more deals to manage, way more investors to manage. So something that we're experiencing now, and this is our newest struggle, is before we had the classic problems that everybody has. We're deal constrained and we're money constrained. And then sometimes it's a little bit of this or a little bit of that, right? And now we have a third constraint, right? We're struggling to find deals, we're struggling to raise money. And now there's this third constraint, which is we're human constrained. We don't have enough people, we don't have enough time to manage all the things that we want to do, which is an amazing problem to have because it's very fixable, but it's nonetheless, it's a problem. So we need to go back, we need to rebuild our systems, look at our processes. How do we improve? How do we streamline things? And who do we hire to make the biggest impact? So I think that's a really fascinating struggle that I'm dealing with right now, that I think a lot of people, maybe already have been through it, haven't gone through it yet, haven't thought about it yet. But I think the earlier you prepare for this, the better.
Absolutely. And you really nailed that. So what is your first priority in terms of hiring? Is it investor relations? Is it asset management? Kind of talk through that scaling.
So I'll take a step back and kind of describe because I was on a webinar a couple of weeks ago and I walked through what I kind of picture as the perfect scaling process for a multifamily business like ours. So I think the first thing you need is an analyst, because your lifeblood is your deal pipeline, and you need to make sure that deal pipeline is running. You're getting the best deals in the door, and that you're analyzing them, and you're building that out. That's again assuming that, because this is just the way it has to be, is whoever is kind of the founders or the partners, they have to own raising capital, because especially when you're starting out, investors don't want to talk to anybody but you. You're the person, and that's who raises money. Even if that's not really your strength, they're investing in you in the early beginnings, right? They're not investing in some well-oiled machine in this company. So that's why I say the analyst side is important, even though capital at the end of the day is the lifeblood of the business. So I would go analyst number one. Then you could, then hopefully your analyst is doing a good job and you're buying deals. And now you need to manage the deals better. So you need an asset manager, because there's just so many things happening on the operations side. So you get the asset manager. Then I think it would make sense, like you said, the investor relations side, which is something that we've done kind of in a more ad hoc way. We just had everybody chip in when we can, the asset manager chips in to manage this. And I've been taking on a ton of it. So I don't have experience with kind of bring that in early, but I could see that being very valuable. And now we're at the point where we're hiring more analysts, more people on the operations side, multiple investor relations people. So I think you're just scaling up across those verticals of acquisitions, investor relations. And then what's interesting, that maybe I get your take on as well, is under investor relations, there's actually three things. There's marketing, investor services, and true investor relations, right? Marketing is posting on LinkedIn and coming up with content and managing stuff like that. And then investor services is managing the investors when they're actually committing. They have a quick question about the investor portal. They want to wire funds. That's investor services. And then investor relations is truly, hey, I'm a real human. Let's get on a Zoom call. Let me tell you more about us. Let me walk you through our new deal, right? That's a very high touch, very quality sales position or department. So it's interesting to see other companies that I'm familiar with, how they've broken all that down and how they hire out, because we don't really have a, marketing department necessarily. We just kind of roll it all in and just make it happen. But yeah, so it's interesting to see how other people do it.
Absolutely. And the biggest thing that I've noticed in the difference of those who are, into the, 500 million, $1 billion range is really obviously, marketing is huge, of course, right? Especially in this digital age, you've got to be content focused. You really, and I know for, I've followed you for a while, you put out very good quality content, and that's also important, but really it's just about keeping in front of them, right? And then really that investor experience is where you really separate yourself, right? What is it like when they join the list? Are you reaching out? And listen, like a list of 10,000 investors is great, but if you can have a list of people who align with your values and you align with theirs, personally, that seems to be what is the most effective amongst some of these larger corporations. But everybody kind of has their own methodology there. But the most important factor is really that investor experience from when they first hit top of funnel to wiring you the check. And then of course you can't forget about them after and taking care of them through the whole process. Yeah,
agreed. It's definitely not a glamorous thing to be doing, but it's super important.
No, it's a little bit under talked about, much like asset management, right? Everybody's like, oh, cool, we acquired the asset. Well, great, now the work begins. And that's where that's also kind of an under talked about thing, because it's important. You're running a business now, right? And that's kind of the face of that operation side of things. So, all of those facets are huge. And it sounds like you guys are learning that and how important it is to make sure you have people in the right place. And in the beginning, you're pretty much doing it all yourself. So, it's figuring out, what your superpower is and then delegating the rest.
Yep, exactly. It's a fun journey. It's something that I really enjoy. I like people and processes and team, being on a team, being a leader of the team, all that kind of stuff. I really like that.
Absolutely. So I know your one of your big superpowers is your underwriting. You obviously wrote a book on it. You kind of have this proprietary underwriting model. So let's kind of get into that. How did you even discover that you loved underwriting? Did you just take it on from the beginning and ran with it, and kind of talk about that whole process?
It was probably the aspect of the business that I was most attracted to first, because I'm a numbers person. And on top of that, it was a way for me to better understand the business. Because if I'm going to be investing in multifamily, I want to understand why and how it works and why the numbers make sense. I don't like to just do things without knowing why, right? If I'm like, I take boxing classes that I started a few months ago, and I don't want to just know to be told I need to turn my hips. I want to know why I need to turn my hips, right? That helps me learn. So same thing with multifamily. I don't want to just, oh, here's a good deal and this is an exit cap rate. I want to know why. So digging into the underwriting was a great way for me to really wrap my arms around the business. And also I naturally took to it because I'm just a numbers person and enjoy that. So, but it has been a really fortuitous thing to kind of latch onto, because like you said, I'm really well known for underwriting, which is amazing because it's allowed us to grow our platform so much and establish myself as a thought leader through the book that you mentioned that I published almost a couple of years ago now. And just, the webinars and podcasts and things like that. So it's been an amazing journey to grow our business through that angle, because not that many people play that angle. And I think it hasn't fortunately pigeonholed me either. Yeah, sure, maybe sometimes I'm known as the underwriting guy, but I don't think it has kind of stopped me from branching out.
Right. Yeah. And that makes perfect sense. And also, from an investor standpoint, when a deal finally gets in front of them, they know that they have someone who is so diligent in their underwriting, so much so that you're even known for it. So it's not like, certainly, if an investor is doing their own due diligence, they're going to do their own underwriting, check your model, of course, but ultimately they have that little bit more faith because they know that's truly what you're known for. And so that probably helps in that aspect as well.
Yeah, and we're very transparent. We encourage our investors, if they want to, please underwrite the deal. Please, we provide our underwriting just in our base package. We don't provide our underwriting upon request, or we don't. There's people that keep it hidden and say, "Oh, this is a top secret thing." We give away our underwriting model for free, so it's been downloaded over 5,000 times. So tons of people use it that are both active and passive investors. And then that same model that we actually then take and populate with the deal specific information to drive our return projections. Like I said, we provide that to all of our investors as well.
And what is it about your model that is different from some of the others that you've seen in the market?
Yeah, a model at the end of the day isn't rocket science. So there's not crazy features that make it so much better than the competition. There's plenty of good models. The things that I like about our model is it's simple. Some of kind of the simplicity about it is all the inputs are on one tab, so you don't have to go from page to page to page to input all the numbers that you need to do. All the inputs are on one tab, and then the outputs, kind of the summaries and the pro formas, are on other tabs. So that simplifies things. And then going back to simplicity, I built it with simplicity in mind. My objective with the model was, how do I make the most accurate, robust model with the least amount of inputs, right? I want to get the most bang for my buck. Because yeah, you could sit there with input, and then get a pretty accurate picture, but how do you do it with the least amount? And so that's the other simple aspect that I think is that people appreciate.
Absolutely. And there's something to be said about simplicity, right? Like, in the end, like you mentioned, there's a lot of good models out there, but especially in today's marketplace, when you have to underwrite, 100, 150 deals, it really speaks to being able to make that as simple as possible.
Yeah, that's exactly right. I mean, I think that 100, 150 is a perfect number to shoot for. Where, we underwrote 500 deals last year and we bought 4. So it's right around that math.
That's crazy. So what are some of the indicators that you're paying attention to? I know you guys are really hyper focused in Houston, but what are kind of some of those economic indicators you're really watching as we move forward?
As far as macro stuff,
Yeah, macro stuff, even, Houston based, and even, a lot of scary underwriting kind of coming into some of these deals. So what are you paying attention to and like seeing out there that, worries you? And then also, some things that are positive.
so you just can't stress enough how much debt plays a role in our business. And I didn't say interest rates, I said debt, because obviously interest rates are really important, but debt is kind of that more precise key component, because with interest rates they can go up and down, and lenders can absorb some of that movement, or interest rates could be staying flat, but then lenders are out of sorts and doing funky stuff. So at the end of the day, what's happening in the debt market is so critical, and being nimble and able to shift and kind of figure out the best deal structure for your deal is very important. So kind of one of the biggest ways that I'm kind of keeping my ear to the streets, paying attention to macro stuff is looking at interest rates. I'm looking at what lenders are doing. So I'm on the phone with lenders, understanding, okay, what are you guys seeing in the market? What does your underwriting criteria look like? Because at the end of the day, the best underwriters in the business is not us, it's lenders. Lenders are very rigorous, and they have their metrics, and they kind of set the standards. So it's important to understand what those standards are, which then help us underwrite and understand what's possible for our deals or what we should be shooting for. So that's something I'm paying attention to a lot. And otherwise, in the underwriting itself, the key components are rents, growth, and the exit cap rate. And for those that aren't familiar, the exit cap rate is basically the determining factor for what price you're going to sell the property at, which obviously has a major impact to your returns, because if you sell high, you're going to have higher returns. If you sell lower, then lower returns. So anyone can turn that dial and say, yeah, in 5 years from now, we're going to sell for however much and we're going to make a killing, right? May or may not be true. The thing about it is it's speculative. So I can't tell someone that they're wrong for thinking that they're going to sell for X price in the future, because who knows where the market's going to go. So we're not trying to predict the future. We're trying to stick to our underwriting philosophy and be consistent. So that way we're comparing deals apples to apples, and yeah, just not trying to influence our biases into the model.
Yeah, that's awesome. That's a really great philosophy. Do you typically structure it the same for most of your deals, or does it kind of change deal to deal?
So, we love to do agency debt, but today agency debt is very difficult to do. It doesn't make sense, because agency debt is long-term financing. It's usually 10-year debt, and because cap rates are so low, you can't really get good agency debt on properties today. It's a very tough time for agency leverage. So we haven't done any agency. I mean, the last time we closed an agency deal was in November. We were very fortunate to find a great deal that was at a very good cap rate. And that was at a time when interest rates were lower. Interest rates are higher today, so it's even harder to find a deal that works, just because cap rates remain low. So we've been doing a lot of bridge. So we've done bridge and agency. And then lately we're exploring, because there's so much volatility in the interest rate environment, and lender spreads have blown out, generally speaking. It's made bridge loans more expensive today, and the forward curve is projected to go up. So what we do is we look at what the market is predicting for the future path of interest rates, and then we forecast that out into our underwriting model. So right now the market's saying, oh, the Fed's going to raise rates every month and it's going to be crazy. So that crushes cash flow. We look out 2 to 3 years into our model. We go, oh my gosh, cash flow is getting crushed. So we're trying to do everything we can to combat that. And that's what I would say is, as far as looking at underwriting, it's the number one way that we're killing deals today is because maybe the IRR, right, the total returns look good, but the cash flow, we can't live with it. Because cash flow, I like to say, is, it's a major component of why we invest. And it's not only the benefit of cash flow, it's also a risk mitigant. If you have cash flow, it protects your downside. So that's keeping us from buying a lot of deals. We're looking at that, but there's other ways to work on that cash flow, right? We're always looking to massage the deal and try to make it, try to improve it. So buying an interest rate cap to where you put a ceiling on your floating rate. So if you have a floating rate and then it crosses your ceiling, your interest rate cap, it'll stop it there, and that'll be your max rate. So having a max rate and trying to figure out that right fine tuning where to buy that ceiling can be valuable and help with cash flows. And then the other thing is just have a fixed rate, right? Fixed rates are less common in the bridge loan space, but they're out there. So taking advantage of that today seems to me like a really good thing to do.
Absolutely. So kind of explain real quick what a bridge loan is and how it functions.
Yeah, that's a great question. So basically you can pretty much chop up the debt world into permanent financing and then bridge loan financing. So with perm debt, the underwriting is based solely on pretty much the in-place performance of the property. So the lender looks at what the rents are. They're willing to look at your pro forma expenses. So if you say, hey, that owner is using too high of payroll, we're going to bring payroll down. They can work with you on that, but they can't do anything about the rents or the income of the property. That's what they're going to underwrite to. So whatever the in-place income is, you're stuck with that, and they're going to base the loan off of that. And that's a very conservative, great approach for long-term debt. On the bridge loan side, the reason why it's called a bridge loan is because it's really built as a transitional product. When you buy an asset, you have a business plan to fix it up through improved management and capital expenditure, and you're able to bridge it to stabilization or to a new higher stabilized value. And bridge lenders afford you the flexibility of basically not completely ignoring, but able to look beyond just the in-place income and look at your forecast. So your bridge loan is much more like a partner than a lender, because they're not just loaning you money and saying, see ya, have fun with the property. They are often providing you the funds to actually make the renovations. So you don't have to make the renovations out of your own pocket, right? You can complete the work and then draw down the funds from the lender, and that will increase the loan balance. And they're able to, like I said, look out into the future with you and basically come to a agreement with you on your forecast. And that's how they derive their loan terms up front. So that's the major difference. And then the other major difference is time. Bridge loans are typically 3 to 5 year debt terms, whereas perm debt is most often 10 years.
And then that bridge loan, once you've got it stabilized, you're refinancing out of that.
Yes. You can refi or sell. So the other thing about bridge loans is they're flexible. With a 10-year perm loan, you could be locking yourself into a very expensive prepayment penalty, which basically dissuades you from wanting to sell for the first 7 years of the loan if it's a fixed rate. So that's very unattractive for some people. For some people, it's fine. But bridge loans offer maximum flexibility. So after 12 or 18 or 24 months, you could choose to refinance out of the bridge loan and into then a permanent loan, or you could simply sell at that time.
Awesome. Really appreciate that explanation. That makes perfect sense. And why, obviously bridges is the most utilized option, especially in this marketplace. Seems like things are, slated for a 3-year hold and they're out in 12 months. So it's pretty crazy.
Yeah. When the market's hot, people transact faster. And the other thing too, there's an element to it that is unrelated to business plan, because what I'm trying to get at is, because there's been so much new money coming into the bridge loan space, every hedge fund in the world, private equity firms, debt funds, everyone's forming up these new bridge loan options, right? So there's so many new participants in the bridge space, and that's really driven pricing down. So historically, and this makes sense, historically, bridge loans have been more expensive than perm debt, because perm debt is viewed as low risk, right? It's long-term money. It's you're loaning on in-place income. It doesn't get any safer than that. Whereas a bridge loan, you're loaning based on future income, right? It's a shorter timeline, so it's more risky. But because all the competition in the space, actually bridge loans today, by and large, are cheaper than permanent debt, which is very bizarre and also influencing people to choose to go to a bridge loan, even if they're not necessarily endeavoring upon a transitional business plan.
Interesting. It's a very interesting perspective. I didn't realize that. Makes a lot of sense. And so it sounds like the bridge is, with all of these players coming into it, it's just really a private money loan. So almost anyone can get into it with enough funds.
Yeah, pretty much. I mean, there's different ways that these lenders are set up. The cheapest way for them to be set up is through something called the CRE CLO. For 99% of people, it does not matter at all what I'm talking about. So they can feel free to tune out, but that's basically it's basically a situation where the lender makes loans and then they package them up and then they sell them off as bonds. And that's the cheapest way. That's the cheapest money in the debt business, because the bond buyers are willing to accept low coupons. So that allows the lender to then make loans at a lower interest rate. So there's plenty of CLO lenders, and that starts, CRE CLO stands for Commercial Real Estate Collateralized Loan Obligation. And that's the most common. And then there's people that, what they say is, they keep the loan on their balance sheet, because technically when a lender is issuing a CLO, they're selling off a piece or all of the debt and they're not retaining it. They may retain the face as the lender and the servicer, but they may not actually hold the paper. So there's other lenders that actually hold the paper on their balance sheet, in-house servicing. And so that's perceived as higher value and higher level of customer service and more certainty of execution, and usually a more friendly experience, because you know more who you're dealing with. But there's pros and cons of all that, but that's kind of a different topic.
Fair enough. I love it. That was an incredible explanation. Thank you so much for that. We are coming up on time, unfortunately. I know that we could talk forever about this stuff. So I have 5 questions I ask all of my guests. It's the final 5. What's the best advice you've gotten from a mentor?
Wow, best advice from a mentor: think bigger. It's a classic one that always comes back and it's always relevant. It's we get lost in our own. I mean, maybe there's one person out of 100 that's kind of too ambitious and needs to be talked down, but I think most of us need to be told, hey, think bigger, think outside the box.
I love that. It's so true. What is it about your career that makes you feel like you're fulfilling your why?
I really like I like challenges. I like puzzles, and so building building a team and building a company, which is just a collection of people and processes, as well as structuring deals, negotiating deals, all that stuff is super exciting to me. So that's not hitting my why in the bullseye, but it's getting close. I've always been a teacher, so that's kind of my opportunity to talk to investors about this stuff is kind of my way of teaching, building my business and having more employees, my way of teaching. So it's I think that's kind of getting a bit closer to the why.
Awesome. I love that. What's your favorite non-real estate or investment related book?
So, Getting More by Stuart Diamond is a really awesome book. It's a negotiation book, but it's kind of like, negotiation kind of can be seen as a dirty word. It's not at all that way. It's very friendly. It's, hey, how do we all win? One of my favorite quotes from that book is, you and I are about to enter a negotiation, and I say, my one non-negotiable in this negotiation is that you get what you want, because then I can get what I want. So it's kind of those ideas, which I am thinking really outside the box.
I love that. That's awesome. If you could have any superpower, what would it be?
There's so many. I mean, not need to sleep. There's read super fast, be able to time travel, or travel quickly to somewhere. If I could just kind of press a button and I'm in a different city, that'd be amazing, because I spend a ton of time on planes.
Yeah, you do travel a lot. I do notice that, which is awesome. Awesome. And what's the best way for people to get a hold of you and learn more?
Yeah, we would love to have you guys check us out on our brand new website. It's lscre.com. So that stands for Lone Star Capital Real Estate.com. On our website, we give away our underwriting model for free. You can get in touch with us. And we look forward to seeing you there.
Awesome. We will link that in the show notes. Rob, thank you so much. This was amazing.
Thank you.
Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, you know it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.